Hello, everyone. I'm going to start to get you promoted here, so hang on just 1 second. Okay, let's see.
Hi, Gary.
Hey, Dwayne, how you doing, man?
Hey, good, man. You're gonna have to excuse me. I'm in the car, so if I turn on the video, it drops me out.
That's quite all right. Yep. We got a good subject tonight. Assumptions. I know it's funny. A lot of people don't think we can assume assumptions, and we actually can. So Greg coming on and talk about that. So let me get.
I'm here.
Hey there. Hey, G.
Hey, GP, promote me, baby.
Let me get you promoted here. And okay, there you go. Thanks, Gina. Okay, we'll give everybody a few seconds here to get logged in. And Craig, good to see you, buddy.
Okay, I'm here.
Hey, Gary.
Oh, hi, Grace.
Hello. Can you see me?
I can. Good. I didn't know you had the link for class. I should have thought about that. Did Beverly give it to you? Well, that's. I'm glad you're here. That's awesome. So welcome. By the way, guys, Romero is joining the team. Everybody want to give her a high five or a wave or a hello on the chat.
Hi, Grace.
Yep.
Welcome.
Beautiful state of Texas. So, okay, let's see here. We're up to 23. A few more people, then we'll get started. Rob, I'm not sure. It looks like
Okay. Hi.
first part French, second part German.
Oh, it's all German.
Okay. I know the second part, my friend Frolic. Oh, that's Fraulein Montag. There you go.
Polish.
Yeah.
Happy Monday.
So, okay. I'm way off there. I've got to brush up. I'm going to, my dad and I and my brother and sister are going to Germany towards the end of the year.
Oh,
So,
eine Bier, knock eine Bier. That's all you need to know.
yeah. My brother's pretty good with his. My dad's really good with his. And I don't know about Kelly, but there's no way I could last a second unless I did a lot of studying. So in any case, let's see. We're almost at our normal attendance, but we'll go ahead and get this started. So guys, I got a great guest on tonight. Craig Boyle. He and I met through the podcasting a month or two ago, and it was a great conversation. I mean, my first property that I ever bought was through an assumption. I assumed a VA mortgage. The guy that owned the house was still active duty Navy. And he had a second mortgage that we refinanced, and then we had to still give him a third for the remaining equity. If you can imagine that, three mortgages. This was January 1986. And the time of the closing, I'd only collected my third paycheck. I got paid weekly then for my first professional job in computer science. And so a pretty interesting transaction. But over the years, you'd hear people say, oh, you can't assume mortgages anymore. And turns out that wasn't altogether correct. And we're not here to talk about what's assumable, what's not assumable. We'll give you some case studies tonight and give you some examples. But Craig also has a pretty awesome program he created to help people through the process. All right. And I'm going to let him get into all that, but I just want you to think about one thing here. Up till this past spring, what were interest rates prior to that? Just call them out.
Oh yeah.
Who saw rates in the high twos?
No.
Who saw rates easily in the threes? Lots of them. Guess what rates are now? Yeah. So let me ask you this. If you have clients facing a 6 to 7% mortgage rate, and they thought there was a possibility of assuming a mortgage with a rate of 3%, you think they'd be happy to hear more about that? Okay. Well, there's paperwork involved, there's steps involved, but I want Craig to explain all that. So first off, Craig, thank you very much for joining us, man. I appreciate you coming on and teaching. I know it's supper time, you know?
Oh, no problem. Thanks for having me. I'm always excited to share on this topic and what we do and how we can help people. So,
Awesome. Yeah. Well, this group here, we're spread out pretty far and wide. We're in 36 states. A couple of Canadians are on possibly, and various degrees of experience, some beginners, some, you know, seasoned veterans, and possibly even a few investors on. So kind of a wide range of people, and obviously it's live, it's interactive, it's engaged. And this group will definitely, once we open it up, they'll definitely ask questions. So, yeah. But if you want to start us off, and then if you need me to promote you so you can share a screen for anything, or is it strictly just?
no, I don't have anything I can really need to share right now. I can probably just cover it verbally and
Okay.
go from there. So, I guess I'll start with who I am. Craig O'Boyle. I'm from Colorado Springs. I'm actually a 27-year realtor myself. I started at 19. And, but the reason we're connected is not necessarily because I'm a realtor, but because we have started a company called Assumption Solutions, which is effectively entering into the new market of the reemergence of the assumable mortgage, which became a thing last year when rates went from, like you said, 3% to the 6 to 7% range. And our company, what we do is we help agents and their clients, buyers and sellers, successfully complete an assumption by processing the deal on behalf of all parties and dealing directly with the servicer. So the big question is, obviously, what's an assumable mortgage? Well, an assumable mortgage effectively is any loan that is taken over at sale and transferred to the new buyer from the new seller. But not all loans are assumable. The only assumable loans in the marketplace are the government-backed financing loans, the VA loans, the FHA loans, and then the small percentage of loans out there that are USDA loans. So conventional loans, your standard loan products in the conventional market, they're not assumable. They all have the strict due on sale clause, and only the VA, FHA, and USDA have the assumables. But truthfully, that's depending on where you live in the country and where you operate, that's somewhere between 20 and 30% of the loan market. I live in Colorado Springs, and we have a very high military presence in Colorado Springs with having the United States Air Force Academy based here. We have Fort Carson Army base, Schriever Space Command, used to be Air Force Base, but now it's Space Force. Peterson Air Force Base, and NORAD, which is famous as well. So I have dealt over the years as a realtor with a lot of VA buyers, and I've sat a lot of closing tables where at some point the topic of the assumability nature of the VA loan would come up. And I always said to clients, hey, if rates ever change, you may have an asset. Well, here we are. And so a partner and I kind of put our heads together and came up with our company, Assumption Solutions, because we saw an opportunity to help sort of get this market rolling, help people get through it. Because I know personally as an agent, I have enough to deal with on the agent side. You know, I don't need to become an expert in everything. There's a reason I have a home inspector. There's a reason I have a good lender. They're experts in their field. I'm glad they get paid to be experts in their field, and I can focus on the nuts and bolts of finding something for clients, helping them contract, and guiding them through the process as much as possible. And so, yeah, we're here to help fill the void and answer questions about the product and the process and everything we can to make this market grow.
Awesome. Well, I want to lead the questioning with this. So what I did way back in 1986, I'm imagining that was clearly far different than how we assume today. I mean, back then it was literally, I mean, there was no qualification, just sign a piece of paper, and these two 23-year-old kids were now the proud, happy owners of a 4-bedroom ranch in Virginia Beach, and we picked up this guy's mortgage. But kind of take yourself forward here in today's world, and maybe we can break that down so everybody can understand what really is. What are the steps today? What's required, for someone to be able to do this,
Well, first of all, is differentiating what you did versus what's out there. There's no such thing anymore as non-qualifying assumables. They all have to be qualified. So even when I got licensed in 1995, occasionally we would see a non-qualifying assumable pop up in the DOS-based MLS system that had just come out. And really, we would run out the door because, yeah, anybody who could shake a piece of paper basically could assume those things. So we would try to do them ourselves. Those are pretty much all gone. So they're only qualifying. So what has to happen is a willing buyer and a willing seller on a VA, FHA, or USD loan have to come together in a purchase contract, and the existing servicer has to process the assumption. There's no new loan created. So there's no new loan officer, there's no loan originator, there's nothing like that. It's dealing directly with the servicer. So our role is we engage both parties. We engage with the seller, we engage with the buyer, and this allows us to communicate directly with the servicer on both parties' behalf. We gather everything through secure portals, secure means that we need from a buyer. That is effectively the same kind of things they would use to get a new loan. And we compile that into a nice, neat package and deal with the servicer to get them to review that and go through that. There's definitely some lifting up front that we have to do on the seller side. One of the things is we have to oftentimes deal with servicers who, maybe don't even have a clue about how this process works themselves because it hasn't been a thing forever. So sometimes we find ourselves dealing with servicers who are giving their sellers inaccurate or incomplete or patently false information. Sometimes we have to get the servicer in line, show them the actual guidelines that are out there from the government organizations that they should be following. Right. And sometimes we see packages coming out that the servicers seem to think that it's almost the same as a short sale, which obviously it's completely different. And so we have to correct a little bit of that. We go back and forth with collecting what's required from buyers, sometimes from sellers, dealing with servicers to walk this through to completion. We tell people to expect it to take, if you're extremely lucky, maybe 30 days. We haven't gotten one to close that fast yet. I think that timeline will come down. The guidelines they're supposed to be approved within that timeline, but the servicers aren't meeting those guidelines yet. So we tell people 60 to 90 days is probably the process they're going to be looking at to go through this to completion. Once we get completion, obviously it closes like a normal sale. The seller, let's say they've listed their home for $500,000. The assumable loan is $450,000. That difference we call the assumption gap. We tell everybody that you really need to think of this as your down payment. There's no guideline that says that can't be financed, but we haven't processed one that has been yet because we don't know of any lenders that are willing to jump into the secondary financing market right now. And we don't believe a lot of servicers are actually going to allow it to happen because they have a lot of discretion with regards to this. Because keep in mind, this isn't a great thing for servicers. It's not a negative like a short sale, but if they have to keep a 2.25% loan on the books versus that loan going away and them reloaning the money out at 6.5 or 7, they're definitely motivated to have new loans rather than assumed loans. But this is a process that's a function of the government loan. So they really can't just arbitrarily go, no, we don't want to do it, even though we've run into some that have tried and we've warned them truthfully, that they better be careful because they could be opening themselves to some pretty serious legal liability by creating losses and denying the loan holders rights and benefits that they got when they took the note out. So.
All right. Okay. Well, that, if you guys have any questions on that, is that pretty, actually, let's do a hand raise. Is that clear? Or you still need, maybe who needs an example of what we just talked about?
Yeah, there's also a question in the Q&A if you want to grab that.
Okay. Let's see, this is from Tanya. Hi, Tanya. Do you have to be an agent to work with Craig's team, or can I bring a deal to him as an investor without a real estate license? So Craig, I'll let you take that one. It sounds like Tanya's not a licensee, but she may have an opportunity to bring your way.
No, so we are not hired by the agents technically. We're engaged by the buyer and the seller. So we can work with anybody in that circumstance. If I didn't mention it, one of the key things is these are only assumable by owner occupants. So it's not an investor product. If it was, I think we'd be swamped, truthfully, because there's a lot of high net worth individuals that see the value of taking over a product that is definitely cheap money, cheap interest rate.
Yeah, I agree. Okay, and it's Mariah. Let me know if it's Mariah or Maria with the H. I think it's Mariah, but let me know if names are important. So I like to know the proper pronunciation.
Yes, Mariah. Thanks.
Oh, I got it right. Good. I get a gold
I
star.
get Maria a lot though.
There you go.
Yeah.
Go ahead, Mariah, if you have a question. Yeah.
Yeah, I was just wondering, since it's owner occupied, is there terms on how long the owner has to stay before they sell or make it an investment property?
So you're assuming a loan that is government-based, and a VA or a veteran or a FHA buyer can definitely convert a owner-occupied property into a rental at some point. The biggest thing is the biggest key is intent, right? If you intend to pretend like you're going to be an owner occupant, assume the loan, and then within very short order, you turn it into a rental, effectively you've created loan fraud because you violated the intent. But think about veterans who buy their home on a VA loan. All of a sudden, 3 months later, the military says, well, we're shipping you to a different duty station, and they have to move. And they decide, well, I can't sell it, or it doesn't make sense to sell it, or I don't want to. And they have to rent that property out. It's hard to say that there's a hard and fast timeline, but I think you really need to think about it at least a year or more as far as owner occupancy. What you do from there, I think you're much less likely to run afoul of the loan fraud rules.
Okay, I was just wondering if that was part of like the assumable contract, I guess, like
So,
if they would put like a term on there.
Yeah, so there's not,
Okay.
I mean, all you're doing effectively is signing something that says that you have assumed the loan in place. So the
Okay.
loan doesn't change at all. So you're dealing with your standard deed of trust from the government-backed agencies.
Okay, thank you.
Hey, Mariah, have you probably you've known people who would buy a home and then, fix it up, right? They'll fix it up and either flip it, but they'll be there, generally 2 years or so, or keep it to rent it out. Is that kind of what you're thinking? My dad used to do that when I was a kid, by the way.
Yeah, that's exactly what I do. I usually stay a couple years and then try to invest in another property, but I wasn't sure if that was allowed.
Absolutely.
Okay.
I personally have done the same, not through an assumption. But when I bought my first home as a young man, I rented out rooms while I went to college and worked in real estate, and rolled that forward to the next thing and the next thing and the next thing. So it's probably, from the investment standpoint, it's the best hack you could do with regards to the assumable loans.
Mhm.
Yeah.
Nice.
Have you seen anything else like that, Mariah? We're actually, what part of the country are you in?
I'm just outside of Chicago
Okay.
for now.
Okay, I've been up there quite a bit, teaching all the way out to Rockford and down in
Mhm.
Peoria and Bloomfield or Bloomington, I forget, and
Yeah,
Champaign.
Bloomington.
All over. Yeah, but
Mhm.
have you seen opportunities like that where people are maybe selling and you can see in their tax records they just bought it like 2 to 5 years ago? Anything like that popping up?
I haven't seen it at all. I just heard Craig on the Bigger Pockets podcast just today, actually. And I was on the website when I caught the class, but I didn't even realize that assumable was a thing, and just wasn't sure like how to even find it in the Midwest.
Finding it is kind of the biggest challenge right now is what I'm trying to cross over, and that's by educating agents. Educating them primarily about what it is, but then how to expose it. Because the more these become exposed in the marketplace, the easier they are to find, the more transactions that happen. Obviously, that's good for our company. We're a transaction-based company. So we're trying to get the word out there, and we do that through classes just like what we're doing here, wherever we can connect with agents to expose this, because agents are on the front line of dealing with home sellers and home buyers, and getting these exposed, it's crucial. Where I'm locally, I think we are the most robust market for this locally, because we've done so much local training to our agents that every day I see new homes hit the market in Colorado Springs that list the fact that it's got an assumable loan. We just need to spread that word everywhere. So I encourage you to talk to local agents. If they don't know anything about this, send them our way. We'll train them, right? And then they can start exposing it to the public and to the clients that they're talking to.
So Craig, since you're not really brokering a loan here, you don't have to have a loan officer's license. So basically you can operate anywhere, correct?
We do, yeah, we can do this anywhere in the country because we're not a lender. Now, my head processor, who touches all our files, is a lender. She's been a lender for 30 years. She's my go-to lender in my real estate company. But I brought her into this because at some level we don't pre-qualify buyers, but we have to vet them, right? You don't want to take a listing into an assumable deal where it comes off the market for 30, 45, 60 days to find out if the servicer is going to approve this buyer. So we look at each buyer and vet them. And the way we say it is, if we don't take the deal, it means we don't think we can get it to the finish line, which means you probably shouldn't stay in the transaction. And the nice thing about having her is she knows all of the loan guidelines, all the requirements that are in the lending world, much more than I ever want to as a real estate agent myself.
Okay, so let's say I'm working with a seller. They have an assumable VA, because we do have a few military around where I'm located. They're going to PCS, go someplace else. They want to dump their house. What's the process for having them do that with you, and what are the fees involved?
Sure.
And how does that work as far as from an agent standpoint?
Sure. So let's talk a little bit about VA, because there are some special things with regards to VA that are specific to only the VA assumables. Anybody can assume, any owner occupant can assume a VA loan. But if it's veteran to veteran, the two veterans can swap their VA eligibility, one off of the loan and one onto the loan. If it's veteran to non-veteran, that eligibility that they used when they took that loan out remains tied to that loan. Doesn't mean that they don't have VA eligibility to go on and do another VA loan, but that's a kind of a complicated math problem that's specific to markets, right? So we've done VA files where we've seen both. We've seen veterans who are like, it's going to be veteran to veteran only, and we've seen ones where it made sense for them to walk. So when you take the listing, the process is we don't really get involved until you have a deal where it's ready to process, but we do give advice. So the first thing that the seller should do is they should actually connect with their servicer and tell them that they're going to be marketing the home as assumable since they have a VA loan, and ask the servicer to send out their assumption packet. Now, one cautionary tale I will lay out here: don't let the servicer talk them out of doing this. They will give you a lot of misinformation. And sometimes when you get the packet, you will see things that don't make sense. We have seen servicer packets say that it could only be assumed by like a relative or a family member. That's false. We have seen servicers tell clients that sellers can't make a profit on the sale of their home. That's false. And we have lots of stuff to back this up and correct them. And we even get VA involved if we have to. But if you get the packet from your servicer before you even have a contract, you've probably taken 2 weeks off the process, maybe more. So getting that packet was there, because when you go to market the home, you're going to market it every way, right? You may get a buyer who wants to assume it, but you may get a regular buyer who has no interest. So there's no point in us getting involved and charging fees until you have an assumption deal. Now, what do we charge? So we charge at engagement to get involved. When the buyer and the seller engage us, we charge our total fee for completing assumption is $550 per side. So the buyer pays $550, the seller pays $550. We charge each party up front a $50 fee of that. Now, we only collect the remaining $500 from each party when we get a successful assumption approval from the servicer. So if it doesn't go through, obviously, everybody's disappointed. We don't charge a fee if we don't take the deal on, meaning if we decide, whoa, this buyer, we don't think they can get it done. We haven't charged them anything. If anything, we hope that we've just simply saved everybody a big waste of time. And so, yeah, that's our fee process, and that's your best process for getting things started with a seller.
Hey, Craig, how long does it normally take? Let's just take, and it could be any loan, any of the government back or quasi-government back loans. Is it the same screening process with a regular borrower getting a first mortgage, like the screening and vetting and all that, or is there a different process? How long does it take actually? So they don't do, my lender is better at explaining this. Every deal is the opposite of a desktop underwrite. I think they call it a manual underwrite. Mm-hmm. So, but they are screening them based on the same criteria that the loan was when it was originally taken out. Okay. All right. And if you wouldn't mind, two questions. PF, he wanted you to elaborate more on what I first mentioned, which is, as rates go up, why is it more appealing to assume a mortgage that was taken out, 2 to 5 or 7 years ago?
Well, I mean, I look at it like this. So let's take a $400,000 mortgage, right? A year, and let's say November of 2021, rates were about 3%. A year later, they were about 7%. On a $400,000 mortgage, the difference is about $953 a month. Yeah, that's pretty large, right? So you take that over time, that's a lot of money over time. Because I can foresee that a lot of these low rate loans, why would you ever pay it off if you can avoid ever having to do it? Because it's probably never going back there. So there's a lot of value there.
Right.
But let's say it's not the lowest of the low deals. There's one that we're involved with that is my favorite story so far. The loan is 15 years old. The assumption gap, meaning the difference between the price and the loan being assumed, is $500,000 on an $800,000 home. The buyer, though, is all over it, because think about it. He's bringing this money, he's assuming this loan, which the bulk of the interest in an amortization schedule is front loaded. So most of it's been paid. And yeah, he's not the lowest interest rate, but he's lower than what he could get today. And he's got the cash. He sold a house in, I think, Hawaii. He's coming to Colorado Springs, and he has the ability to cover that big, large gap. So to me, it's the most financially savvy deal I've seen come through so far. I love it. I've told the story 100 times.
Yeah, you're right. That if you think about amortization, I mean, a larger portion of your payments going forward are going to be applied towards the principal, so you're building up equity a lot more rapidly than if you took a brand new first mortgage out. I mean, it's a huge, and I looked at this before, Craig, I can't remember the math on it, but it seems like on a 30-year mortgage, you actually don't turn the corner midway through till somewhere around year 20. It's not like halfway through gets you halfway through the loan. It's because the interest is all front loaded, so it takes longer to get to the halfway point, compared to a 15-year term or something like that. Another question, looks like from Susan and Rob Lane, they're trying to, I guess, clarify the cost. If and by the way, guys, I'm assuming, Craig, these costs can be passed on to the consumers. It's not like the agents are paying this, right? The consumers.
Our contract is directly with the consumers.
Gotcha.
Yeah, so they're the ones engaging us. Now, we have had deals where agents want to pick up the fee for it. And the way we say the best way to handle it is just give them a discount on your commission for the amount of the fee at closing, right? Because we charge the buyer $550 total and the seller $550 total. So for us to be involved in a transaction to completion is $1,100 total. We charge, of that $550, we charge the seller and the buyer $50 upfront just for engaging with us, right? And getting us going. Now, let's say we have determined that it should go, but like 3 weeks in, it falls apart, and the investor says, for some reason, there's some shocking thing that comes up, and it's like, no, we're not going to allow this to go. Then we don't collect anything else. We're only collecting it at approval. And we do say at approval, because if we get you to the finish line and you decide not to close, well, we did our job. So
Yeah. Hey, I'm just curious about too. I seen when I did mine, it was not only better and easier because back then there was no qualification part of it, but also I don't think the fees were all that great. What are the lenders themselves? What are the investors charging? Do they charge any more, any less?
they can charge. What we're finding is it's landing between 1,000 and 2,000 because these are government-backed loans. They can't go crazy with their fees.
Right.
I kind of wish they charged a little bit more, because if they did, it would be more attractive for them to do it, and it would become easier, right? So there's not a massive incentive for the lenders to go whole hog into these, because it's not a huge profit center like new loan origination is. But there is fees. And then on the VA, they charge, VA has their funding fee. When you take out a VA loan, there is a 0.5% VA funding fee for doing the assumption. And that can only be waived if the veteran has some kind of disability rating.
Yeah.
But the closing costs in total are generally much lower, right? You don't have the big loan origination fee. You don't have an appraisal being done and things of that nature. So by and large, to get this to the finish line, it's even more cost efficient for both parties.
Yeah, it sounds like it. I'm excited because I honestly I knew VA mortgages are assumable, but I wasn't clear on the fact that now you do have to be a veteran yourself, you know. If regular citizen can't assume a VA mortgage, but the other ones, I mean, I knew that some variable rate mortgages could be assumed, but those are typically investor loans or commercial loans. But for these other ones, USDA, for example, till I met you, I had no idea they were assumable. Who here is kind of blown away by this, at the fact that you can assume all these different kinds of mortgages? I mean, I'm like, you know, it kind of dispels all the stuff we've been told all these years, you know, it's like, you know, it's crazy.
I
Okay.
probably wouldn't be that familiar with it either if we didn't have such a huge military population in our marketplace. It's
Yeah.
a big factor here.
Yeah, we've got a couple of Coloradans on here. I think I saw Craig Cannon. He's in your neck of the woods. Let's see if he's still on. He may have logged off. I'm not sure, but Craig and then Jody Desmond's out that way. But beautiful state. It's a lot of fun, you know.
There's a couple of questions in the Q&A, Gary.
Okay, let's see. Well, yeah, we got these. This was oh no, this is different. Okay, can you explain the 500K loan to 450 again? Does that mean 50K is what you have to put down?
Correct. Yes. So the delta or the difference between purchase price and whatever the assumption loan is, think of it as down payment. You know, the big question I've gotten over and over and over is, because VA or FHA tend to be low down payment loans that are used heavily by first timers. But there's no guideline that that says you can't finance it, but we're not seeing that happen. We don't think the servicers are going to really allow that to happen very much, irrespective of the fact that good luck finding a lender to do it.
Yeah.
Right, that wants to finance the second. So yes, the delta between the purchase price and the loan being assumed is down payment. And we are seeing, you know, it's easier I think it's easy for agents sometimes to go, oh, well, that'll never happen. We're seeing it. I mean, like I said, my favorite deal is somebody bringing in a $500,000 gap in cash to assume on an $850,000 loan, like a $350,000 or purchase price for $350,000 loan. So it is happening. And there are a lot of people, just like the people who in the crazy times found a way to come up with the extra 50,000 above the appraisal. You know, people are figuring out, people are getting, I mean, you can have family help out. There's lots of things that you can do to come up with that cash gap, and people are doing it.
Yeah. Well, here's what I'm thinking. Actually, you know, if that the example you gave there with I guess that mortgage is close to 15 years old now. And it's $800,000 house, and the guy's putting down essentially half. Is that right? He's
no more. He's putting down $500,000.
$500,000. Okay, 500,000.
Yeah.
I'm thinking this. I'm thinking, okay, I could buy the house, assume that mortgage. I've only got, you know, less than half the years left on it, but I can get a line of credit on the equity in the house. In other words, not going to fixed rate second mortgage, get an actual line of credit that I can draw on to make a down payment on an investment property, right?
Mm-hmm.
And then refinance that, pay the line of credit back, so you keep using it as a bank, you know?
I'm a big fan of that. I do that on my own personal residence, actually.
Yeah.
Yeah.
Amen. And that's what I'm talking about. So, okay, let's see. Now I want to correct me too, Craig. I think I misspoke a moment ago. So on the VA, if an assumer is not a veteran, would the VA let that go, but the eligibility doesn't get relieved? In other words, the veteran, he's still potentially he or she on the hook.
Yes. So anybody can assume a VA loan as long as they're willing to live in the property, like all of these products.
Gotcha. Okay.
But veteran to veteran, the special thing about veteran to veteran is each veteran has eligibility for taking out a VA loan.
Mhm.
And what that means is they can, when they assume the seller veteran,
Mhm.
his eligibility as well as being released from liability are completely off that house, and he can take it anywhere he wants. But veteran to non-veteran means whatever amount of eligibility that was used up in taking out that loan remains on that house. He's released from liability,
Oh,
meaning
okay.
he's not on the hook for any liability for losses, but his eligibility for a new VA loan is tied up when it goes veteran to non-veteran.
Gotcha.
But the key is it's not always like saying all of your eligibility is gone. That's not how that works. It's a complicated mathematical formula that people smarter than me know how to figure out. So let's take the example of that big deal, the 800,000 deal, right? If that person's eligibility totaled 500,000, but they only used 350, right? There's still a formula that says, okay, well, you have eligibility left,
Mhm.
right? The seller of that home's leaving with a lot of cash. She could probably technically go get another VA loan. It wouldn't be necessarily 100% financing because you got a lot of down payment. That particular deal is veteran to non-veteran. That seller is elderly. She's downgrading. She doesn't need a loan on her next property. So letting a non-veteran assume it, she doesn't care. She's like, okay, whatever. I'm going to my last home.
Yeah.
You know, we've had some deals where, quite frankly, the veteran's like, I just need to get out. I don't care who buys it, how buys it, what happens. I need to be sold. And they're willing to walk because they're like, okay, I mean, at least I'm making a profit, or I'm getting out of a burden.
Mhm.
And I'll get a conventional loan in the future. The key is the loan is no longer on them for responsibility. It's not on their ratios. They're no longer on the hook for it at all. And so a lot of veterans will make the decision, I think, to say, yeah, okay, I'm out of here. This is fine.
Well, I tell you something else you mentioned there that's come up a couple of times, and I'm actually happy about. When I was a kid and assumed that guy's mortgage, he was still on the hook, I think. Like he wasn't relieved of liability. I think it was like 3 years or something. I don't know if that sounds right, but now with the qualification requirements, the seller is relieved from liability. And
Yes.
released. Okay.
Yep. All of these programs, they're immediately relieved from liability at sale.
Okay.
And so the motivation, I think, of a seller to do this is it's one more piece of leverage when you're selling a property.
Right.
Your agent should be marketing your home and all its assets, whether it's a new kitchen, a great view, a big lot, or an assumable mortgage,
Mhm.
right? Not every home that's got an assumable mortgage will be bought through an assumption, but the ones that do, it might be specifically because. And so if people are out there hunting these specifically,
Mhm.
I would think, can either sell for more or sell faster, which in a declining market, selling faster often means you're selling for more.
Right. Well, the other thing too is that the market, as it slows, and again, guys, it's the weirdest thing, but the market shifts occur at different stages and different frequencies in different parts of the country. I mean, there's parts of the country where people are still outbidding each other, and going above, list price. But in most areas, though, there's been at least a correction in pricing, and longer days on market, fewer offers coming and things like that. So what I'm getting at is that seesaw shifts, and it could be months, could be years. I mean, you just never know. Which it's one thing we can't tell you, what we can do is guess. What I'm getting at though is this makes a property a lot more marketable. Not just because typically it's a lower rate that people will be assuming, but it opens up the marketplace to more people. So I mean, it's just a good thing. Yeah, I'm sorry. Go ahead.
In my business, in my real estate business, I have used this to resurrect buyers. I've had clients that when things really shifted in 2022, they threw their hands up. They were move up people, meaning they had things to sell. So they had a lot of equity, but they're very payment sensitive. And so I went and I sat down with them. I showed them this stuff, and they are 100% back hunting, but only for these types of homes. Now, it's not always easy, right? Like, you've got to balance what they want in a home with what they can deal with in the monthly payment and how much gap coverage they're able to pay for their down payment, right? So it is a puzzle, but yeah, it's a great way to resurrect people into the market who are payment sensitive.
Yeah. And Susan Murray, she's in Lynchburg, Virginia, by the way, and sometimes Maine. She does some work up there with her kids in Maine, but the question of liability, is that just related when it comes to an assumable mortgage? Take the example of the veteran, is that they got the, well, I guess it's a moot point now, but I guess in the old days, that liability referred just to the mortgage payment, right? Nothing else. Like, in other words, if somebody slipped and fell at the property, the seller, whoever allowed their mortgage to be assumed, was not, there's no, they can't be held liable.
Well, the seller has sold the home like any regular sale,
Okay.
right? If the buyer who assumed that loan stops paying on that note, the foreclosure would go on the new buyer, not the old owner and seller, right? They're no longer liable or financially responsible for anything to do with that note. Now, there is one caveat with the veteran to non-veteran. When a veteran goes through the foreclosure process, it hurts their VA eligibility in the future, right? So if you've walked from your eligibility and that person doesn't ultimately pay that note and it goes to foreclosure, it's going to permanently affect their eligibility, right? Versus the truth is if somebody assumes that note as a non-veteran and your eligibility is tied up, but let's say at some point they either sell it or they win the lottery and they pay the loan off or whatever, the eligibility releases back to the original veteran, right? So there is no financial responsibility for losses, but there can be an eligibility hit. Now, to me, if you've putting down a heck of a large chunk of money to assume a 2.25% loan, the likelihood of you just completely defaulting on that loan is probably super low. It's not zero, but you've paid the down payment. You've jumped into the lowest thing in as far as monthly payment that you're going to find probably ever in your life again. Are they really going to let these loans go to foreclosure or go bad? I don't think so.
Yeah, I agree. That's why I'm thinking having the qualification process in there was a great move. I know it makes it tougher on people trying to buy, but I mean, when I did mine, I was 20, I just turned 23. I mean, to me, that's a risk, but it worked. But today, they're more qualified, or they were absolutely be qualified. And you're right, they got more skin in the game. I think the risk is a lot lower, so I think banks probably like that. So the only thing a bank might not like about it is, the alternative is they can maybe sell a 6.5% mortgage versus let somebody assume a 3.5% mortgage. But at least they get they still have they've already made their money, so it's not like they're losing money. They've already
right. And as real estate agents, going out to the people you're connected to, a lot of us have done this. You want to go talk to your loan officer, like, how do I do this? Unfortunately, there's no motivation for your loan officer because there's no fee income based on this. There's no way for them to go back to the servicer and be involved again to redo a loan origination fee. So it's kind of like if a for sale by owner came up to you and says, can you tell me everything I need to do to sell my house on my own? So that's why we saw the opportunity for us. We're like, okay, there's an opportunity, because agents, we want to help clients and sell more homes no matter what, right? But we need a resource that's willing to do this. And we felt, okay, we can provide that resource. We can be that conduit to get this to the finish line.
Yeah.
It's not like assumptions have to go through our company, but what we're finding, we do get quite a number of deals where people have tried to do this on their own and tried to figure this out, and have finally thrown their hands up and said, can you help us?
Yeah.
We're like, yes. So our goal is to be the first stop, not the stop of desperation for them,
Yeah.
but to help save them time, energy, and effort and get them to the finish line.
Yeah. Well, I imagine, think about it, guys. In a more conventional situation where someone's buying a home, getting a brand new first mortgage, just think of all the loops that are being jumped through. When you have a mortgage loan officer there making sure all that happens, and you get to play your role as a realtor. Or here with assumption, if you don't have somebody doing that for you, like Craig, where does that responsibility usually end up falling? You're just like, you're it. So the bank, they're bank employees, and who knows, maybe this might not be their highest priority.
Well, and as a realtor, you have to deal with a lot of sensitive financial documents. Do you want that? I don't want that in my real estate business at all. So I do see a question in here where I think the same person asked, kind of how we got into this, or how did we figure it out? So the model was actually born through something my partner did. My partner owns the largest title company here in Colorado Springs. And in 2008, when things blew up and all of a sudden a huge piece of the market became short sales, he said, okay, how can I position my title company as a resource to get more deals? And he created a company called Short Sale Solutions, which effectively did the exact same thing we're doing now, but was processing short sales. The plus side of this is there's almost nobody involved in the deal has an absolute pain point. And lenders in short sale situations were just doing everything they could to limit their losses. Like, okay, we're gonna lose $100,000 in this deal. Where can we find any piece of money that one of the parties might be able to come up with to give us? Obviously, that's not the case here, but it was proven out. The model was proven out in that time of dealing with short sales. And we said, okay, let's just pivot, and let's do something that's at least everybody involved is somewhat happy about. So.
Yeah. It's funny you mentioned, because I was thinking that earlier, maybe an example of comparison would be the short sales. When I used to do those, they were horrible. I mean, back in the last recession, they would take over a year, and then the mortgage would be sold. Then you got to start all over again with another file. Just crazy. But I will tell you, when I worked with an attorney, this guy was advertising, hey, I'll help you do all these short sales and I'll charge you a flat fee of $1,000 and blah, blah, blah. I thought, well, I don't have to pay that. The client can pay it. And man, it cut the time in half, literally. It was
that's exactly our goal. Yeah, that's exactly our goal. I knew a lot of agents that took on the headache, and I'm like, I don't have time to call a lender and just see where they're at. I mean, I was on the short sales side as an agent where I would be in deals, and I was happy personally as an agent to pick up the tab if I thought I could get the deal done. I remember I would take listings and I knew they were a short sale, and I had people that I would be like, just write me an offer, because I know they won't even look at the deal until I have an offer for them to process. I don't care if you buy it or not, at least I'll get an answer from the lender as to what they'll take. And then the next buyer can come in and complete the deal. So.
Yeah. Hey, so the three major types are VA, FHA, and USDA.
That's the only types, correct? No conventional loans at all.
Okay. All right.
No, I see the same person with another question here. Another piece I should say is you will not be able to get an assumption completed on a property in distress. So if the mortgage is not current, if it's behind, or it's in a short sale scenario, it's not going to happen.
Okay, that's interesting. Yeah, because I can see some people thinking the buyers, well, maybe if I give them enough money to pay the mortgage, the payments in arrears, maybe they're 3 months behind, it could be $3,000 or something. That could be risky though, you know.
Yeah, I think the servicers, they are, if they can find a reason, a legit reason to say, no, we would rather have this money freed up to lend out at a higher interest rate, they'll go that route. And so the distress side of things is a reason for them to do that. And so could that change in the future? Like if we went through another cycle of massive downturn and losses, potentially, I mean, anything can change, but right now we want, if we find out the loan is in forbearance or we won't even take the deal because we haven't seen that as even being a possibility.
Yeah,
Craig, actually, I meant just a regular short sale. I have a couple of properties that I had listed that I would love to have been able to get them through as short sales. Do you still do short sales?
I could talk to my partner about that. We didn't partner specifically in this company to do it, but he does still have short sale solutions. I don't think he's done anything outside of Colorado because the original creation of that company for him was just to grow the title company, to grow the title business. But I'd be happy to connect you. He's a great guy and a great resource. I don't see any reason he couldn't do it outside of the area. But, until we got into this venture together where I was like, okay, I'm going to take the lead on marketing this thing outside of our region. I pretty much market this thing all over the country. And he focuses a lot on our local marketing because he teaches classes to like 90% of the agents in Colorado Springs. That's why our market is so many agents know about it in our market because they've gone to him teaching this class versus me, who's teaching it through this webinar. Or, I've done, I just got back from New York from the Inman conference. I met Gary down at Florida. And I'm kind of the national outreach for it. So maybe is all I can give you there.
yeah. Hey, we have another question on watching the QA box and then the chat box too. It is an interesting subject. I hadn't thought about this because this could possibly happen in certain parts of the country. What if the loan is current, but it's upside down? In other words, the value of the house has dropped to below the value of the, I don't know what would technically, there really wouldn't be a short.
I mean, you'd be walking into it with no gap, right? You'd be agreeing to say, I'm okay with taking over this loan at a higher value than maybe the home is worth because I want the payment savings. And I believe effectively that the value of the home will go up in the future, right? The seller wouldn't get anything out of that scenario except for getting out of the house without a foreclosure. Right. So that's a great scenario for the first. I mean, honestly, if we get there, where I hope we don't, where equity we've seen has been eaten up so much, a couple of the homes that may be closed in 2022, this could happen on. But yeah, then that opens up absolutely to buyers who are like, okay, I'm buying this house for the payment. I don't even care about the price.
Yeah. That could be a good no money down scenario. You just step in and start taking over payments and no fuss, no muss, and who knows? Do some remodeling, get it above what it is now. So you never know. But those things tend to come up more and more when the market does start to go down. More of those opportunities. So hey guys, we're right at the 8 o'clock mark. We're welcome to stay, but I'd say if you have any questions for Craig O'Boyle, let's go ahead and get him out there because he may have other plans too. And I'll stay on up till 8:30 if you guys want for any subject, whether it's this subject or any other subject, transaction issues, client challenges, things like that. But for now, if you have anything else you want to ask Craig, please speak now or actually, Craig, is there a way can people can you put your contact information in the chat box? Because
Sure.
group is pretty active. I mean, we were one of the few teams that actually had an increase in production in December.
Awesome.
Imagine
So-
that.
And Craig, I was curious, are you able to handle these in Texas?
We can do it anywhere in the country. I know Gary mentioned he
Okay.
had some people in Canada. Unfortunately, it's not a product because it's not a government backed program up in another country. So anywhere in the country we can do this.
Gotcha. Okay, cool. Thank you.
Yeah, if you don't mind, Craig, sharing, I know that some of these guys, I think there was at least half dozen commissary. Can we get Craig's contact information?
You know what? I'm trying to type it in, but I'm not sure I'm doing it right.
Oh.
Hold on, let me see.
Yeah,
I
take
may
your
have just sent it to one individual. I can't say that I'm the best. Okay, yeah, maybe this is how I do it here.
You should.
So, okay, yeah, so there's our website, assumptionsolutions.com. I'll go ahead and put my, I don't even mind putting my cell phone number out there.
I'll repaste. There we go.
Okay, so maybe I sent it the wrong way. So,
No, I think you're okay. I just like to be safe because I know it says post and panelist.
I
But
see it.
learn everyone. Okay, good. Everybody should have been promoted. Everybody should be at least a panelist, if not a host. So, but Craig, I gotta tell you, man, I know this was longer than a podcast, so I really do appreciate you doing it.
no problem. I'm no rush. I told the family I was doing this, so they're all good. If anybody's got any other questions or wants to chat about anything,
Yeah,
I'm open to all of it. So,
yeah. Well, I definitely appreciate it. I mean, then what you're offering too, I mean, for the value you're bringing, I mean, essentially, if you think of what a loan officer does, a mortgage banker, mortgage broker, whatever, there's a lot of hoops they're jumping through that if an agent and client try to do this on their own, they're not getting that. There's nobody playing that major role. And here you guys do it. And it's a lot less than if you did have a mortgage broker involved, you know?
Hey, Craig, I have a question. On your website, do you provide any kind of ideas for like marketing the service for agents?
yeah, so a big part of the training, we didn't get into that much, but a big part of what we do in our training is teaching agents how to go out and, connect with sellers and educate the sellers about the asset they have. And, if I go on a listing appointment, you can go to our website under the agents tab and you can download a flyer that is something you can put in your listing packet that is an education piece that we created, right? We encourage agents to leverage us on their behalf. Say, hey, I'm an expert. I've been trained by Assumption Solutions. I can help you get this on the market and get this out to hopefully get you, who knows, another 10% of buyers that are interested, 20%, 30%, 50%, whatever, right? And I do talk in some of the classes that I put on about strategies for trying to find sellers of these. And some of them are just strategies that I've personally tried. You can find data sources that will give you stuff for direct mail for people that took out loans that were of these type, VA, FHA, USDA, and you can create marketing direct to them, however you do that. You can go to your own sphere. I talk a lot about how you put this information out into social media. If you use that, I'm pretty active in that for my marketing. I do videos where I talk about it. You can steal anything you want from me. You can say, heck, if you've got a good idea, I'd love to hear it because I'd love to use it. So whatever we can do that. Then I also talk a lot about when you get the listing and you have this to market it, make sure you're doing everything you can to expose this. Make sure you're highlighting, like I said, let's say you had one with a $400,000 loan. You could highlight, hey, if you buy this house and you assume this 3% mortgage, instead of going to get a 7% mortgage, you're going to save $953 a month. Buyers are going to see that. They're going to call you. They're going to be interested. Well, how can I save $950 a month by buying this home? look in your MLS. Make sure your MLS, see if your MLS has fields for the assumable nature of the mortgage. Ours does in Colorado Springs, and the big provider does our MLS, Core, I don't know if it's Core Logic or something like that. They do a lot all over the country, right? So see if you've got fields in there. If not, make sure in your remarks fields, put the information. People want to know, you know, how much is the loan balance? What's the PITI payment? What's the interest rate? You know, if I'm going to buy this house and take this over. You want to be very intentional about getting the word out on this and getting this spread. When you look at your MLS and go in there right now, I did this with a one-on-one call with an agent in Washington. I was like, okay, go to your MLS and see if there's a field for assumability and just hit yes if it's there and search. And she found 50 homes in her MLS in Washington, and she didn't even know they were there.
Wow. Yeah. Hey, Grace Romero has a question. Grace, looks like your hand's up. I just clicked the unmute button to see if you can unmute yourself. I know we did earlier today. Or even type in a chat box, Grace, if you want to do that, you know.
Can you hear me?
Yes,
Hello?
Yep.
Yeah.
Okay. What are your professional opinion, or is there any activity in anyone's market about one prospect and another prospect trading, and there's a difference in equity and there's a difference in the price?
You mean where they're swapping homes? They're not actually,
But
boy,
one may be higher, like a commercial, and the other might be residential.
I don't know that I have any good opinion or good advice on that. I've never come across that situation.
Are people trading, one downsizing and the other one wants a bigger home?
Every deal that we're involved in on these, it's just a normal sale. The only thing abnormal about it is, you know, no new loan is being created. You know, the buyer comes in, buys the home outright, brings their down payment, and instead of a new loan, they take over the existing loan. Yeah, I'd have to think on the tradability side of things and how that would work.
Okay.
Thank you, Grace. And PF, I just saw a question pop in there. Let me, yeah, how was the assumability field named? I'm trying to think what mine was. I think I actually just said it was a box you check, assumable yes or no, if I remember for mine.
That's the same for us. We have a little box that says it's actually a required field in our MLS that defaulted to no, because no agent ever used it for the last 20 years. Yeah. But it was a drop down that just said yes or no. And then we had input fields in our MLS where you could then input like the loan amount, the payment. I think it's important to put in there if it's a VA loan, whether or not, well, any type, you should always put in the loan type. But if specifically if you've got a VA, if the seller is not willing to entertain veteran to non-veteran, that's useful information for buyers to know so they don't waste your time. If they're open to anybody assuming it, that would be important to know as well.
Okay. Okay. Well, good. Okay, everybody all set? Any final questions? Going once, going twice, and guys, I'll stay on if any of you need to stay on for anything, any other stuff. Oh, you know what, Craig, I actually do have something. I don't know if you know this or not. I know it's not directly related to this, but there was a message that came out, I think last week, that FHA had changed something in their rules that will allow real estate agents to receive a referral fee on mortgages. And to me, that's like RESPA 101's like, no, you can't. It's like, no way that's going to happen. But apparently, and I just Googled it earlier before class, I couldn't find anything. Have you heard anything
No, I haven't heard
Yeah.
anything about that, but I'm the same as you. That would surprise me because they're always very anti, coercive practices. So.
Yeah. I mean, it's not that you can't also have a lender's license. That's not it. Like I used to own a title company and we did a lot of the closings for our brokerage clients, but we disclosed everything and that was the rule. This is different. They're saying you don't have to have a license and you can receive a referral. I just don't get it, but I'll see if I can find information on that guys for you,
Interesting.
Okay, well, guys, I'll stay on, but Craig, thanks again. And I think everybody got your contact information, and let's stay in touch. I mean, there's a lot that I mean you bring to the table, and you and I've spoken before, like on the podcast, and there's more to Craig O'Boyle than just assumable mortgages. So you're a great colleague to be in partnership with.
Oh, I loved it. I definitely have enjoyed getting to know you and looking at your stuff as well. And I get your things, and absolutely. I mean, yeah, and I'll put this out there, you ever need a realtor in Colorado Springs, I've been doing this 27 years. I love to help buyers and sellers. So.
Wow.
That sounds good. So, okay.
I think Miranda here has a question.
Oh, I'm sorry. Go ahead.
Sorry, no, that's fine. I was gonna ask him if he had any, if there was like any servicers that he found was, more of a headache than others.
Like
But you don't have
servicers?
to, yeah, you don't have to answer that though. I'm not
They're
even
all
sure if you can.
headaches, to be honest. They're all headaches. No, I'm lucky enough that I actually don't deal much directly with the servicers. So sometimes I have to hear the stories from the processing side, but it's getting better. They're starting to know themselves this is coming. Matter of fact, we did, I think, communicate with the servicers today that said they had 300 of these in the pipeline.
Wow.
And I was like, okay, that's the first time I've heard that. It made me smile for sure. So.
Oh, very interesting. Well, thank you.
Yeah. Hey, Mariah, did one of the other students invite you to class? I mean, it's open to the public. We'd love to have you on again, and we all like your questions,
Oh, yeah. So I just I went to the website and I saw that, it had just started 2 minutes ago. And so I jumped on.
Yeah. Oh,
She might have found it, Gary. I link all the stuff I'm doing on our website as future classes. So we came out on another podcast today, and my phone literally blew up today. And so I think a lot of people went to our website and probably saw that I had your class linked as something we were doing.
Okay.
Awesome. So you've helped us. We want to help you too.
Yeah, absolutely. Yours, I'm not sure when yours is getting published. In fact, I'm going to write this down and ask Beverly tomorrow. Craig.
Well, and when you do, we share it out on our Assumption Solutions Facebook page too. So.
Okay. Yeah. All right. I'll ask for that tomorrow. We generally have 3 to 4 months of podcast inventory, but I think the timeliness of this was actually, I think I'd rather have this one get published ahead of some of the others, but I'll check that out tomorrow. So, okay. Hey guys, while you're listening, just to give you a heads up, so next week, a guy named Brett Bowers is coming on to talk about land, and you as a agent, transacting land, even buying land. I mean, let's face it, who here thinks land in the last couple of years has become like the new gold? It is. We got several land development projects on the team as we speak right now.
I'm one of those too.
Yeah, I tell you. I mean, I'm looking. I've been part-time in Florida, and I started going to Inglewood the summer of 2020, and I could have picked up a 2-bedroom condo, Gulf View or Water View for $250, and then last summer was up to over between 500 and 600. They're now in the 900s. In land, you can't even. It's just ridiculous. I mean, it's like the new gold. So I would definitely be in on that one. And then on the 13th, a guy named Chris Wider's on. He's ranked as in the top 50 speakers on the planet but he just wants to talk to everybody about mindset because of the shifting market. And, he knows what it's like to be a realtor, and it's a slightly different subject, but I thought it was really timely after we went through vision, goals, action plans to help bring in everything in a perspective, So, so that's what's coming up. If you want to invite guests, and Mariah, you're certainly welcome to join anytime you want. And any of the other guests, Tom's always good to see you. Tom Wall, you're always welcome, and lots of new agents. So, okay, well, I'll stick around, guys. If you have questions, let me know. If not, I got, I think, one more piece of apple pie. So vanilla ice cream. So that's going to be my treat for today. Okay, going once.
Gary, I got a question.
Oh, yep. Hey, Craig.
Yes. So, oh, and great class, Craig. Thanks.
You're welcome. Thank you.
So I closed a transaction on Friday.
Mm-hmm.
So they got my commission wrong. They got it all wrong. I don't know why they did it this time. Never did it before, but they charged me like a regular team, like a 50-50 split. So she was asking me, are we a standard team? I forget, a standard team, or it was like 3 different types of teams: standard, domestic, or self-organized. I know we're not domestic.
Yeah, it's technically a standard team, but they consider us a specialty team.
Okay.
Because we're national, and the second thing is it's an education-based team, so your split is not a permanent split. Like once you've hit, it could be 12 transactions or something. What we call Group A goes away permanently. It doesn't, or so our team split doesn't reset on the anniversary date like EXP split does. So once you hit that limit, then everybody goes to 5%. So I wonder if you're getting close to that part where you're switching in the Group B, which goes to 5%. They're trying to. Let me write this.
Yeah.
What's the property address?
28 Shallot Court, CHALET,
Shallot.
and that's in Anderson, South Carolina.
Yeah, I remember that one. Okay.
Yeah.
Or I'll take a look. They did have
I know.
new people there, and I know one lady was like the other person would completely. She's been with us since we started. EXP assigned her to us, Brittany, and then this other person stepped in and started to help a few other, actually several people, but they do ask a lot of questions, and I'll have to see if maybe I know I saw one come through on Friday, but it was like 7 different transactions in it. None of it made sense.
Yeah.
Like, holy smokes. So I'm going through all those now and trying to help them figure.
Yeah, because I was wondering, because I know usually in Sky Slope it has, your split, your and Gina's split in there. I don't know if I actually saw it on this one or not.
Oh, okay. I'll have to take a look at
Yeah.
that.
Yeah, check it out. I'm not sure if I did, but when I went back in the archives, I didn't see it.
Okay. I know when they do close something, it's like it goes in a limbo for a day or two. You can't find it on active transactions or closed transactions. It literally like disappears, and then all of a sudden it pops up. And I think that's when they actually disperse, is when it goes back. Then it goes into the closed category on
Okay.
Enterprise. Yeah. You won't
All
be
right.
able to see, there's stuff in Sky Slope. All you see is the notes. It's an EXP Enterprise transaction summary where you see what actually happened. But the trick is you can only see your amounts. You can't see anybody else's amounts. You can't see
Gotcha.
Gina's, or, it'll have my name, but it's, it's the team and anybody else that's involved. It obviously, it's like for privacy purposes, but
Yeah.
it's easy to decipher once you get used to it all. So I'll look at that. I'll try, maybe I can do that tonight, Craig, and then tomorrow morning, whoever it is I got to speak to, I can speak to them,
Yeah, they said they was gonna send it on up to mega teams or something like that.
Yeah, they wouldn't know what to do with it. So we're called a specialty team. So they actually have people assigned to us specifically,
Gotcha. All right. I'll email her back right now.
Yeah, she's probably really confused now. So
All right.
that's all right. Hey, we're successful, and they do treat us, really, really well. I mean, we pretty much have our own, like we have our own support, pretty
Yeah.
good. So yeah. Okay.
Cool.
All right, let's see.
Kendra.
Hey Kendra, how you doing?
Good. How are you?
Fantastic. You're on fire, man. I saw another one. Didn't another one come in recently for you?
Closing on the 9th,
Okay.
I have a
Cool.
question about property management, as I've been approached by a couple of people
Okay.
to manage their properties. But I was told that with EXP, we cannot do that. Is that true? And if so, is there a workaround that?
Yeah, there is. And EXP as a corporation does not offer it. And I've been instructed to not even really talk about EXP's position on it, but all I can tell you is, as a matter of fact, their E&O policy does not cover it. So even if they wanted to, they couldn't offer it. Now, the reason I bring that up is it comes up like twice a year. And there was a rumor going around that they were entertaining the offering that the corporate entity offering that, are allowing us to be part of it under the EXP umbrella, because they would add a rider to their policy to cover property management. Now, assuming that hasn't happened yet, and I haven't heard, so I'm assuming it's not happened. Here's two workarounds, and these are all legitimate. We currently do this today. We've run up all the way up to the top. I'm involved personally with a couple of these. And one way is, if you want to set up a separate LLC, this is what's actually what you have to do.
I do have an LLC.
Okay. And it's its own tax ID, and you need your own E&O policy. Okay, that covers property management, and you need a separate broker of record. So here's where it gets different state by state. In some states, if you have a broker's license, you can hold it at different entities as long as you disclose to all the entities. Hey, I've got a broker's license here, got a broker's license there. North Carolina is one of those states that lets you do that. So is Virginia. Pennsylvania, their process is you actually end up with a second license. You have your typical licensed salesperson or associate broker, and they have what's nothing called a multi-license that allows you to house it at multiple locations. Now, I'm telling you this because in Pennsylvania, I actually have a Pennsylvania license. My Wyoming license is what I use for EXP. I have 3 licenses. One of them is inactive. The active one that I use for my business EXP is in Wyoming. The Pennsylvania license, the only reason I reactivated it was we had brought in a large team that also had property management. And I walked them through the process of setting up everything, corporate structure, everything, and I became his broker of record with that additional license. With permission from EXP, there's a document that has to be filled out and approved and signed and all that. So I'm actually playing that role there. Now, in other situations, this is what we do in Tennessee with Brianna Latham. In every state, by default, you can manage properties for one owner, regardless of how many units they have. They can have 100 units, but as long as it's one owner or one owner entity, you can manage properties for them without even having a license, Yep. Now, let's say you bring on a second client and you don't want to go through all the rigmarole of having a separate broker of record and all that.
Right.
What you can do is this: you can set up a separate company like you have that's strictly for the management part. You're taking care of maintenance and repairs, collecting rents and things like that. But here's what you can't do. This is true for the former approach too. With the one in Pennsylvania, that agent that owns the property management company, his license is with EXP, right? All his sales are done through EXP. Management is just pure management. So what I'm getting at is, if you want to take what we call property management light, where you don't want to have a separate broker of record, you don't have all the complications, you could set up purely a management company that only does maintenance, repairs, collects rents and things like that. But you can't do any sales through it because it's not a sales entity, and you can't do any leasing through it, but it's okay because you do your leasing through EXP.
Got it.
Yeah, go ahead. I'm sorry.
I said, got it. That makes sense.
Yep. And then the one thing that's really important, Kendra, is under no circumstances in that latter approach can you hold an escrow account. The owners of the properties have to take the security deposits from tenants and put them in that separate escrow account, and it has to have the word escrow in the account title.
Okay.
And separate from operations. So you're going to have an operations account where you collect rents, pay out maintenance repairs, and then the remainder goes to the owner.
Okay.
technically controls the security deposit, but they can't touch that money because it actually belongs to the tenant. It's called escrow law, and they're basically, they're managing that money for the tenant.
Mhm.
Okay, so the owners need to be aware of that, this is a serious thing. And it's actually based on federal law. So if somebody screws up with security deposits in an escrow account, it's a major deal. It's not like a misdemeanor kind of a thing. It's a big deal. So some agents choose that latter approach, Kendra, so they don't want to be involved with all that escrow.
Right.
nonsense. They can go wrong, and it will, you know, I've seen that firsthand, what happens when something goes awry. And it's a big deal. It's a major deal. So I'm trying to scare you. We do it several times on the team. If you want to set up a call with me, we can go through.
Yeah, I plan on doing that because I have
Okay.
some other things that I want to talk to you about as well.
Well, it's a tremendous lead generator. I mean, think of all those tenants that might want to buy a house, and then you're dealing with contractors and appraisers and inspectors, utility employees, municipal employees. You know, list goes on, attorneys, lenders, all those people you get contact information for servicing the properties. But
Mhm.
you being a really smart person that you are, realizes, hey, you know what, those are contacts too. And I can approach them about buying and selling a home or an investment property, you know?
Sure. Yep.
Yep,
All right. Thanks, Gary.
you're welcome. Anything else, guys? Everybody okay? All right, well, listen, we'll see you next Monday. I don't think there's any other meetings this week. Hang on one second. Agent Attraction Mastermind, that's Wednesday at 2. You might want to be on that one if you guys are interested. We're going to show you what we're doing. And an ad that we're running that's working really well. Help you build up your downlines. And then I think that is it. Oh, Community College Teaching Group is Thursday at 2. And you can find these links on the GIA workplace page. So, okay. Other than
Thank you
that,
all. Thank you, Mr. Wilson. Enjoyed.
oh, you're welcome. Thank you, Grace.
Greg, you're wonderful. Very important information.
Thanks
Thanks.
for having me, and thanks, Gary. I much
Okay.
appreciate it.
Yeah, thanks.
And I'll
Craig.
talk to you soon, Mr. Wilson.
You're very welcome. Thank you. And Craig, thanks again for sharing with us. And I'm sure we'll see you again, man.
Sounds good. Talk to you soon.
Take care, guys.
Thank you, Gary.
You're welcome.